Hi, good afternoon. I'm going to talk about the Arca Continental, and then I'm going to explain you how is the financial situation expressed or represent, how it represent all of the aspects in the income statement and the balance sheets. These are allow us to express the performance of all of the results in each year. And then I'm going to explain some parts of the financial situation with all of the ratio that expresses the performance of this company. And this is important because we can understand how we can make a financial analysis. So first, I'm going to start with express who is Arca Continental. And Arca Continental is a subsidiary that distributes, sells, produce non-alcoholic beverages in Mexico, Peru, United States, Argentina, and Ecuador. And this company represents a main part of this sector and market, and because as we can know, this company is a different way to relationate with Coca-Cola. So I'm going to start with the first part of the vertical analysis. Here in the vertical analysis, we can show how is compounded each financial statement between the 100%, who is or what is the aspect that represent the 100% between each year. It's obviously. So then first, the financial statement shows us the financial position. So here we can show that the total asset represent the 100%, and then obviously in the total liabilities plus shareholders' equity represent the 100%. And in total assets, the main important assets here is the property, plant, and equipment that represent the 50.6%. And in the liabilities, the total liabilities represent in 2022 42.3%. The total equity in 2022 55%. And this explains how is component all of the financial position, all of the assets, liabilities, and the equity. Then in the income statement, we can understand that this financial statement express the profitability and all of the operational aspects like expenses and other financial incomes. For example, also the taxes and the depreciation all of these assets. So here we can show that the 500% is the total revenue, and then the cost of revenue represented in 2022 the 55.6%, and the gross profit 44.4% of the total revenue. And also all of these results of the common size balance sheets allow us to represent the ratio and to obtain the ratios to understand the performance position, the financial performance of Arca Continental. Then in the horizontal analysis, we can show how it expressed the rate of change in each part of, also as in the vertical analysis, in the financial statement of balance sheet and income statement. Yes. So here we can show in 2022 understand what is the change between each year. So here in 2022 and 2021, the changes is 2% of the total current assets, and in the total asset is reduced by 1%, and total liabilities increase 10%, total current, and then total liabilities increase 1%, and finally the total equity decreased 2%. Here, obviously, for understand in a detailed situation, we have to show in the report, the annual report, who or what the company do for of each rate of change. Then in the income statement, also we can solve the rate of change with this horizontal analysis and express which percent, which amount it expresses in percent represent the change between each years. So in 2022 and 2021, the change of revenue increased 30%. The total operating expenses also increased to 12%. And the income statement here, we can see that the income statement increased to 26%. Here, let's start with the first part of the ratio, financial ratio. The profitability ratios are the metrics that they use to evaluate the company's ability to generate profits relative to the revenue, well, the assets, capital, equity, and common equity. And this ratio provides us insights into how efficiently the company is using its resources to generate profits. So here the first ratio is return on asset. That means that for each pesos in assets, how impacted the net income. So here the higher is in 2022, and also in the in this part of the probability, higher is better. So it's a good situation for Arca Continental. Then the return on capital at the same time, but the difference in the capital for each peso invested in capital, how is impacted in the net income. So here, as in 2022, the return in capital for the net income is to 8.2%. Then the return on equity, where the equity produced 10.5% for the net income. And finally, the common stock and common equity. And this is interesting result or really interesting insight, because here is a huge percentage of the common stock produced for the net income, 1,596.9%. And this is that for each peso invested in common stock, how this produce a profitability for this company. So in general, the situation of the profitability shows that the company has a good management of all of the resources, assets, capital, equity, and common equity. Then the marginal analysis. The marginal analysis is used to evaluate all of the aspects of the company's profitability, and is the ratios provide insights in how the efficiently company is managing his cost and pricing and products or services. So this is an economic performance, because as we can see in the first part, how the revenues produce the gross profit, and here higher is better, and the higher is in 2021. Then the SG&A margin, and that's the revenue, how percentage of the revenue represent the SG&A and E. And the highest is in 2020. Then the revenues of the EBITDA. The EBITDA is the higher, well, the EBITDA is the result of the revenues, cost of revenues, minus expenses and other expenses, and the EBITDA is not with the depreciation and other financial or accounting aspects like taxes and amortization. And then the EBIT, this without the all of the aspects that explain with the of EBITDA. So here the revenues as the percentage of revenue for EBITDA is 14.54% of the revenue. So then the net income margin, the revenues represent the net income in 2022 the 7.4%. Then we can show other conjunction of ratios, and these ratios expresses or these are used to assess a company efficiency in utilizing its assets to generate revenues. And these ratios measure the relationship between a company sales or revenue and the value of its assets. So that's mean the efficiency ratio or times of revenue represent in each asset, total asset, fixed asset, account receivable, and the inventory. So here, well, the first one explain how what times of revenue represent the total assets. Here is that the total revenue represent the 0.82%, 82 times, and all of these ratios expresses in times. Then the fixed assets, the property, plant, and equipment, the fixed assets, how or what times of revenue representing total fixed assets. So here is that the higher is in 2022 with 3.02 times. The next one is the account receivable. Well, the account receivable and inventory, it's part of the working capital. So in the next one of the account receivable is that the the times per year that accounts receivable are collected. So here the higher is in 16.84% times per year in 2020. Then, as the same part of the account receivable is how many times per year the inventory are replaced or the inventory rotation. Here, the higher is in 2019 or 2019. Here is 11.57 times. Then we have another ratios. Here we have the short-term liquid, and the short-term liquid assess a company ability to meet its short-term financial obligation using its short-term assets. So here in the current ratio, we can show that the current liabilities and the current assets, and that's mean the pesos available per pesos to pay in short-term debt. So here the current assets, how many pesos is or paid the current liabilities. So here higher is better because for more money to pay the liabilities is more liquidity for the company. So the higher is in 2020 with 1.53 pesos. The quit ratio is without the inventory, so it's in the same year higher. And then the EBITDA and the current liability, the companies can pay off its current liabilities with all of the cash that generate in the core business with EBITDA. So with the EBITDA, with all of the pesos in EBITDA, we can pay it 0.94 current liabilities. And then we have the average day sale out. So this is the average of how many days is necessary to collect the credit sales. And lower is better because we can understand that in this way a company can recollect the money fastly. And here the lowest is in 2020. Then the other one is about the inventory, and the inventory as the same part of the accounts of the day sales average. Here is that in 31.11 days, sorry, the company replace it or sell the merchandise for obviously for the sales. And the other one is the average day payable for the suppliers, the time of the supply that the suppliers or the company can pay it for the suppliers. So higher is better because company has more time for pay it, or in this time the company can use the resources to an investment or for another activity that can produce a profitability for the company. So here higher is better. And then the average operating cycle is the summatory of the days sales out and the days inventory out. So higher, lowest is better. So we can show that the 52.69 the times it takes to the companies to buy goods and to sell. Then the cash conversion cycle is a metric that expresses the times that the companies convert all of the invested in inventory and invested in the credit sales. How many times this cycle repeated, and also reduces by the days payable out, because in this time, as I said, the company can use this time for produces a profitability or to invest in other assets or a fixed asset or current assets. So the other one is the long-term solvency. And these metrics or this ratio assess a company ability to meet its long-term financial obligation and its overall financial stability. So here, the first one is that for each peso obtained through the creditors by each peso contributed by the shareholders. So in all of this, lower is better. And well, all of this, lower is better. The first one means that the inequity, the total liabilities, and for each pesos in equity, how many pesos we can pay it for the total liability. So here, lower is better. The lowest is in 2021 as the same part of the total debt and total capital. Then the obtained pesos through the long-term debt by each peso contributed by the shareholders. So here that the pesos obtained is 0.28%. The other one is that the long-term debt with the total capital, and the other one is the total liabilities with the total assets. As we can see in 2022 and 2021, and the insights are the same. Finally, in this ratio, we can see that the EBITDA with the interest expense and the EBITDA with the interest expense. And this expresses the times of EBITDA can covers the interest expenses. So higher is better because this means that for each peso in EBITDA, we can cover the interest expenses. So here we can see that the result is the same, or the sign is the same between this ratio. And finally, the last one's ratio is about the growth over prior year. So here, as I said in the vertical analysis, the horizontal analysis, we can show how all of the aspects of balance sheets and income statement expresses the change in a rate. So here, in all of these ratio, higher is better because obviously the revenue have to increase, and some the same way the gross profit, and also the EBITDA, EBIT, and the net income. So this expresses the performance of the profitability, how the rate of change for these accounts. Then the accounts receivable increases 2,000% according to the last year. The inventory increased and the net property, plant and equipment, total asset decreased 1%. The tangible book value increased 102%. The common equity decreased 1%, and the cash from operation decreased 6%. The capital expenditure decreased 64% according to the last year and 2022. Finally, the compound annual growth rate over 3 years measures or metrics how increase or how is the change of according to the 3 years that I analyze. So here the compound annual rate component an equivalent annual growth rate per year. So here we can see that in all of this, the situation increased, and the total revenue in 3 years increased 8.4%, the gross profit increased 8.5%, the EBITDA 15.2%, the EBIT 14.4%, and the net income 17.4%. Also, the account receivable, the inventory increased, the net property decreased, the total asset increased, the tangible book value over 3 years increased only 1%, the common equity decreased 0.4%, the cash from operation increased 15.2%, and finally the capital expenditures over 3 years decreased 46%. So, as of a conclusion, all of the situation of the Arca Continental shows how the performance or how the financial position is this company. In my conclusion, I think that the financial situation or financial analysis of Arca Continental is a good situation because they had good increases in the main accountings or main accounts. Also, the ability to cover their liabilities in short term and long term, and then the growth over the period for each year and over 3 years is a good insight. So finally, this is my explication of the final analysis of Arca Continental. Thank you.